Hey, welcome back everybody. You're tuning in to howtoplaystock.com. My name's Casey Kepley. Today's video I wanted to just cover the topic of the financial statement again. I've covered this in the previous video, but every now and then, probably about every 6 months to a year, you want to go back and rebudget, make new goals, and just look at your financial statement, from a bigger picture. Just take a step back and see where you are. See if you obtained some of the goals that you set in the past, things of that nature. So you want to treat your financial statement in similar ways that, say companies or corporations will treat their financial statements. Okay? Now they are a little bit different, but they follow the same baseline. And in this video, I'm basically going to give you an example of a financial statement, and I'm going to show you, as an investor, ways that you can basically change your cash flow patterns from poor or middle class to, if you are poor or middle class and you have the cash flow patterns of people in those classes, you can transfer that and change the way your cash flow patterns behave, and you can convert it into cash flow patterns of a wealthy person. But you need to start with the financial statement, okay? And again, I've covered this in the previous video, but I'm just going to touch on it again because for myself, things change, and for everybody, things change through time. And one good thing you want to do every 6 months to a year is go back and revisit your financial statement and see where you are. Okay, so that's basically what I'm going to show you in this video is, where I'm at, and I'm going to use my financial statement as an example for yourself so that in the future you can go back and look at your financial statement and make little tweaks and changes to it for yourself so that you can get on the right page and change your cash flow patterns into that of a wealthy person's. Okay? So stay tuned, and I'll see you in the next video. Alright, so you're tuning in to howtoplaystock.com. I'm going to cover my financial statement for you here, and we're going to use that as an example, okay? So getting started, this is my financial statement as of right now, okay? It's a little bit different than what it was in my previous video that I shot on financial statements and cash flow patterns, and that's simply because, throughout time, things change. So just to give you a brief picture of where I am right now, I'm going to school and changing careers, so I took a major hit with my income and the amount of money I was bringing in. So it's been reduced dramatically, and because of that, I haven't been able to invest as aggressively as I was because the income's not there. Okay, so just to give you an idea real quick, the numbers I'm going to be throwing out here are real minimal. I'm not a millionaire by any means, but I am an investor. I've been investing for about 4 years now, and I've got over 12,000 hours of research that I've done on my own when it comes to investing and the tools that you can use in dealing with financial statements and stuff of that nature. So I know what I'm doing. And so when you're looking at some of these numbers, you're probably going to think to yourself, this is, that's nothing. Okay, $800 is nothing. $300, that's nothing. But again, it's just a number. Okay, so if you're somebody who's making six figures, you can apply this to your own finances, and trust me, it works. Okay, so basically, when you're looking at your financial statement, you're going to break it into four categories. You're going to have income, expenses, assets, and liabilities. All right, that's what you want to break it into, and you want to lay it out just like this. Okay, now I changed the angle in the camera because there was a glare coming in from the light, and so it was blocking some of this out, so I apologize in advance if the angle's a little off here. But I just want to make sure you guys could read this. So, for starters, with mine anyways, when you're looking at mine, my income right now, I'm trying to work a full-time I'm trying to work full-time hours right now as much as possible, but I'm not a full-time employee. So realistically, off the hours that I work, I make roughly about $800 to $900. Okay, now for me, I'm pretty much debt-free. I paid off all my debt back when I was 30 years old. I'm now 35. So for me, I still have cash flow, which is really good because no matter how much money you make, you want cash flow. And that's the main goal here with your financial statement, is to make sure that, you know, that is happening for you. So I make $800, $900 a month, and that's my income. Now my expenses, I'll list them out right over here underneath expenses. You want to do the same thing, and basically, you know, I've got car insurance, gas, phone, and I've got rent, which, you know, I paid off rent for about 2 years and lived without a rent payment, you know, for the house that I'm living in. That has kicked back in. I could have kept going for about another year probably without having to pay rent, but I put that money into school and a few other things and invested in myself. So rent has kicked back in for me, and that brings me to the next part of this. If you guys become debt-free, you know, there are certain things that will happen in life, and you can easily go back into debt. Or if, let's say, you become financially free for a little bit, you can kind of go backwards sometimes, and it basically depends on what you're spending your money on. Okay, now for me, my rent kicked back in because I took the money that I would have put towards rent and I decided to invest in myself by going back to school and paying out for a couple other assets outside of myself. Okay, so that's why I have rent now. In my last video, I didn't have rent, and that again, it just verifies and confirms that things can change throughout time, and this is why you want to do a financial statement, or at least go back to it every 6 months to a year. So that's where I'm at with my expenses. Now I have liabilities. I have one credit card right now. It's about $25 a month. Okay, I plan on paying that off here in the next, I don't know, probably 3 or 4 months. So that's a goal that I've set up for myself. And if you have similar goals, you wanna apply that into your financial statement. Okay. So total bills right now, if I add all this up, I come roughly to about $560 a month. Okay, for me that's not bad. And I can tell you right now, if you're watching this video, you're probably wishing that your bills were at $560 a month. And if they are, I congratulate you. I give you a pat on the back, because that is hard to do, especially, you know, when you're used to living a luxury lifestyle or a lifestyle that's above your means. The key here is to bring your living expenses. You want to reduce them as much as possible. You want to reduce your bills as much as possible. Okay, and some of that might it might demand from you that you live below your means. Okay, so if you're doing that, congratulations. If you're not, then I would highly suggest that you start sacrificing a few things, okay, and start reducing your expenses. All right, and I'll show you. It'll all come back here in a circle in a second, and it'll make sense in regards to why you want to sacrifice a little bit. Okay, so that's your liabilities. Your assets are over here under assets, and assets, guys, are strictly just investments that either pay money to you or they appreciate in value over time, so that it puts money in your pocket. Okay, now, and that's where people get twisted up a little bit. They think assets are things, you know, such as their house. Well, your house can be an asset. Okay, if you're watching this and you've got a home, it can be an asset, but it's only an asset when it's putting money in your pocket. Okay, so if you're renting your house out to someone and you're getting a monthly income off of that, then it's an asset. Okay, if you're getting ready to sell your home and let's say the market's right, you know, your equity in your home is appreciated over $50,000 or $60,000 over time, and you can pocket that $50,000 or $60,000 after you sell, your home's an asset. Now, what people don't understand, if they have a mortgage payment, then their house is not an asset, it's a liability, because it's taking money out of your pocket. And that's the difference between an asset and a liability. The asset, it's an asset to the bank, but it's not an asset to you. Unless you've got money coming in that's paying on the mortgage for the home, or you turn around and sell it, and you make money off of it, it's putting money in your pocket, then it's an asset, okay? So I just wanted to get that out of the way, because that's one of the major confusions that people have between assets and liabilities. It's just language, the language of money. You need to understand assets and liabilities, okay? So with that being said, assets, I've got listed here. I've got an Acorns account that's on automatic, autopilot, so it puts money into into that account, all fully automated for me. I've got a video on that. If you want to watch it, just click the link here in the top of the video, and that'll take you to Acorns and shows you exactly how that's all set up. Okay, and it's just one of my tools that I use as a passive way to accumulate money or currency. So I have that. All right, that gives me about $40 a month. I've got income from my passive income portfolio that I've got set up through my broker account, and that consists of just strictly stocks. All right, and these are companies or ETFs that act like mutual funds. They pay out a dividend to me. All right, so right now I'm only getting about $5 to $7 a month off of those. Nothing big, but again, it accumulates over time. Okay, so I just take my paychecks, I reinvest them, and those, that number's going to get much bigger over time. The other thing I have is a IRA, which is set up for retirement. All right, now this account that I have set up there is strictly allocated for the long term. So it's all basically indexing across the board in multiple asset classes, and I have it allocated a certain way based off of Ray Dalio's asset allocation theory. All right. If you don't know who he is, again, check out the video that I have on asset allocation and the All Seasons Fund that's in the top right-hand corner here. You can check out that video as well, and that goes into detail and shows you how I've got it set up. I've got Google AdSense. Okay, so I make money on Google AdSense through my websites, and then I also have about $1,200 cash that I keep in a vault. Okay, that I have access to, that I can put into, say, a broker account. I can place trades with it, whether they be short term or long term, to accumulate more money. Or basically, what I'm doing is it's my print press. Okay, so anytime I find something that I can buy low in valuation, I'll let it accumulate in value and rise in value. I'll turn around and sell the asset and make more money that way, and just continuously do that and accumulate more cash. Okay, so that's what I've got going in assets. Now, the cool thing is, with all my assets, and again, this is why it's so important to get something paying you and putting money in your pocket, is I can take that money and I can bring it up here into my income. Okay? So right now I've got 4 streams of income coming in. I don't use the IRA because the IRA is tax deferred and it's used for retirement. It's something I'm not going to touch. It's more long term. So I went ahead and excluded that from my income stream. So right now I've got four streams of income coming in, and it gives me roughly about $45 to $130 a month. All right, it might give out a little bit more than that, depending on what kind of trades I make in the meantime. But for me, I mean, it's not that bad, because here's the thing: my bills are $560, my income's $800 and $900. That means my cash flow after I pay all my bills is roughly $240 to $340 a month. Okay, now for somebody who's going back to school part-time and working part-time, that's not a bad situation to be in, because I have extra money. Okay, now I can do something with that money too. I can put it in here to just hold on to for cash and accumulate more and more money that way, or I can put it into assets that are going to appreciate in value over time. Okay, so the cool thing though with the passive income and getting it coming into your income, from the different income streams here, is that I can take the $45 to $130 every month if I want to, and I can go ahead and start applying it to my expenses. Alright? Now the goal here eventually is to make enough income off your assets to where it basically pays for all your expenses and liabilities. Because at that point, you're financially free. Alright? And that's the goal. And you, again, having a financial statement is very important because you can take your goals that I was talking about and apply them to your financial statement every 6 months to a year. Go back and redo your financial statement. You can see where you're at. You can see your progress on paper. And it's really cool. For me, not much has changed really, except for just the amount of money I'm making. But again, you don't have to make a whole lot of money to accumulate wealth. You really don't. And that's the big secret that I think a lot of people aren't in tune with, because they think that, in order for you to make it to financial freedom or be debt-free, that you have to have all this money saved up in order to make it happen, and you don't. You can do basically the quote that I use is 4 base hits are just as good as a home run. Okay, so if you can make small steps and apply it, consistently, you can still hit that home run. And I can attest. I can basically tell you it works because I've been through it. I've experienced it. So that's the financial statement. The one last thing I wanted to cover here is the cash flow patterns. Okay. Now I'm going to show you what poor people do, middle class people do, and wealthy people, and I'm going to show you their cash flow patterns. Okay. And this basically will tell you exactly why the rich get richer and the poor get poorer. So poor people, what they do is they've got income coming in right here. Poor people, all they do is their money goes straight into expenses over here, and then, basically right out the back door here. So the money goes straight out. Alright? And they're left with nothing. They don't have any cash flow left over. It's just the money goes in, they blow it on expenses, and then, liabilities like credit cards and stuff like that, they don't get paid. Alright? Those are the cash flow patterns of poor people. Alright? Now I know this because I was in this cash flow pattern once. I was also in the middle class cash flow pattern as well, and I got out of both of those, and my cash flow pattern now is of wealthy people, which I'll show you here in a second, and I've never went back to the other two because they don't work. So that's the poor people. Now the middle class, and this would be like 85-90% of Americans. The income comes in right here. Alright. Then what they do is they pay for liabilities down here, and then their money goes up to expenses, and then right back out the back door there. Alright? In other words, they don't have any money left over either. No cash flow. And it's not much different actually than the poor people. And we'll go ahead and erase that real quick. Now the wealthy people, what's so different with wealthy people is they basically have income coming in, and it's just like the cash flow patterns that I just showed you with mine. The income comes in, they pay themselves first, right down here. They set up assets, then they go over here and they pay expenses, liabilities, etc. And that's the financial statement, guys. If you have any questions or concerns, leave comments in the description below or in the comments section. And I'm going to make another video here real soon on saving money versus hedging, okay, and protecting your wealth, okay, because there's a new set of rules that the wealthy play by when it comes to investing. All right, so stay tuned for that, and remember, guys, be patient, and income is the outcome.